Welcome to Alpha Insights. I'm Joe. Today we're unpacking a noisy headline about Trulieve and an insider sell plan, and why the reality looks very different. With me is Ben, our commodities and capital markets expert. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks for having me, Joe. Happy to dig into it. There's a lot beneath the surface on this one.
Right, so headlines screamed, "The CEO is selling," but the filings say something else. Start by explaining what an automatic disposition plan actually is.
Sure, an automatic securities disposition plan removes discretion from the insider. Once it's set, the timing and pacing are pre-programmed. Sales are executed at market prices with daily volume caps. In plain English, it's a meter, not a hammer. Shares are trickled into the market, not dumped in one block. So, the real question here is whether that trickle meaningfully pressures the stock. And the answer depends on context.
Okay, so that 2.5 million share number sounded scary. How should listeners read it?
Two important points. First, the 2.5 million is the ceiling, the maximum authorized under the plan, not an immediate market order. Second, put it against the CEO's overall stake. She recently converted 8,200 multiple voting shares into 820,000 subordinate voting shares, so her total economic position is about 19.87 million subordinate share equivalents, roughly 10.33% of the company. 2.5 million is roughly 1/8 of that position. In short, it's a modest trim in context. And don't miss the governance angle. An automatic plan is how a CEO sells transparently, without insider timing risk. That tends to signal compliance discipline, not panic.
Got it. Now the story gets a twist, with a buyback announced days before the plan started. Walk me through that.
On June 9th, the board authorized a repurchase program of up to the lesser of $50 million or 8,495,038 subordinate voting shares, about 5% of shares outstanding, over 12 months. So the company can buy back more than 3 times the maximum the CEO could sell under her plan. Put simply, the issuer can be a buyer of last resort and absorb those sales, which materially changes the supply story.
Interesting.
Exactly. When the company has the balance sheet capacity to act, the worry, who will buy the CEO's shares, mostly evaporates.
The plan starts June 17th, and quarter end is June 30th. That looks deliberate. What's the significance?
Timing matters. Opening the disposition window in the last 2 weeks of the quarter means the sales are metered across a known, finite window. Daily caps prevent any lump sum pressure. Analysts note that such a setup tends to concentrate any technical softness into a short, telegraphed period, the kind of overhang that usually clears rather than lingers.
Yeah, that's a good point.
And look at the fundamentals behind this noise. Trulieve reported a profitable first quarter. Revenue of roughly $287 million, a gross margin around 59%, adjusted EBITDA of about $100 million, roughly a 35% margin, positive GAAP net income, operating cash flow near $56 million, free cash flow near $42 million, and about $353 million of cash on the balance sheet at quarter end.
That's a solid set of numbers compared with the sector.
I mean, when you look at the data, it's not the profile of a CEO fleeing. There was also a structural tax change. Medical marijuana was rescheduled to Schedule 3, which removed the punitive 280E tax drag. The reported effective tax rate dropped from about 258% to about 87%, and the company has filed for roughly $174 million in tax refunds. All of that improves cash generation prospects.
But there's still an overhang on taxes, right?
Right. A sizable uncertain tax position remains, about $696 million, and resolution depends on regulators. There are near-term catalysts too. A broader classification hearing starts June 29th, and the company recently completed an uplist to the New York Stock Exchange, which changes the investor base somewhat. So there are positives and outstanding questions at the same time.
So what's the bottom line for listeners who just saw that CEO selling headline?
Bottom line, the filings show a disciplined, capped, automatic sale, bled out, not dumped, and the board authorised a buyback more than 3 times the sale ceiling. Timing concentrates any technical pressure into a finite window around quarter end. Meanwhile, the company reported profitable cash generation and benefits from the tax reclassification, though regulatory and tax uncertainties remain. Analysts note these are facts to weigh, not a clean endorsement or condemnation. Honestly, I was a bit surprised by how much the headlines missed the buyback context. It's a good reminder to read filings, not just soundbites.
Great, let's wrap with 3 quick takeaways.
Sure. 1. The CEO's automatic plan is capped and metered. Think slow bleed, not a dump. 2. The board's buyback authorization is larger than the sell ceiling, making the company a potential net buyer. 3. Fundamentals and structural tax changes improved cash generation, but material regulatory and tax uncertainties remain. All of this is informational, not investment advice.
If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks for joining, Ben.
Thanks, Joe. Always good to peel back the layers.